One of the most powerful concepts to understand about investing is how dividends work and how they ultimately drive portfolio performance. Here is an example of a major Canadian bank. From early 2005 through the financial crisis of 2008 and 2009 to the end of the first quarter of 2020, the depths of the COVID-19 pandemic. This period includes two of the three greatest market losses in over 100 years. Firstly, a well-run company with high barriers to entry that provides a product or service we can't live without should make predictable earnings. These earnings may fluctuate from quarter to quarter, but over a long period of time, they will show a steady increase. Secondly, many of these companies' management will state a desired dividend payout ratio, or what percentage of earnings will be returned to investors in the form of dividends or cash flow. Often, the rate will be about half the company's earnings. It is imperative to remember that despite a temporary slowdown of earnings during a recessionary period, a solid blue-chip company will continue to pay its dividend. It might not increase it every year, but it will do all it can not to cut it. In fact, because the last recession was brought on by a financial crisis, banks were hit particularly hard. Other sectors of the economy, such as telecoms, consumer staples, healthcare companies, pipelines, and railways, continued to raise their dividends during this rough patch. From 2005 to 2020, this Canadian bank example increased its dividend from 23 cents a share to $1.08 a share, but paused during the difficult times of the financial crisis. A key driver of dividend growth, and as we will see, portfolio performance, is what a well-run company does with its reinvested earnings, or earnings not paid out to investors. Revenue is earned from its product or service and expenses deducted to create its total earnings. Shareholders receive some of this cash, but some is reinvested back into the business to create even more earnings. When this cycle is repeated, shareholders' dividends and cash flow increase. What happened to the stock price of this company over the same period of time? Unfortunately, it is the price of the stock that receives daily attention in the media and is most prevalently displayed on our investment statements. When index benchmarks are discussed, they too are merely the accumulated price of a basket of stocks. However, it is important to understand that despite the share price and therefore the value of your investment going from $60 to $30 a share as it did from 2007 to 2009, the dividend was unaffected. The value of your investment was cut in half, but the cash flow it created was not. This creates a situation where the stock investment is viewed by an intelligent investor as inexpensive and a good buy. Subsequently, the share price climbed from $30 in 2009 to $103.55 at the end of 2019. The relationship between this stock price and dividend growth rate is often misunderstood. It is not the share price that influences the dividend, but rather the dividend and its growth rate that ultimately will influence the stock price. Simply put, what price is an investor willing to pay for an investment that pays cash flow of 23 cents a share as compared to one that pays $1.08 per share? The answer is more, about 3.5 times more. That is why the share price has increased. To explore this further, please see our video, The Magic of Yield on Cost for Dividend Investors. One will find over a period of time your portfolio will increase proportionately to the growth of the dividend increase. The challenge is when the media focuses on stock price, it is difficult for the average investor to focus on dividends. As Warren Buffett says, investing is simple, but not easy. For more information on who we are and what we do, please contact us at blackburndavisfinancial.ca.